SCHD, a dividend ETF that has historically kept up with and even outperformed the S&P 500, has now significantly underperformed the stock market as of recently. I know a lot of SCHD investors are frustrated and thinking, am I dumb for even buying this ETF? Why isn't SCHD at least keeping up with or outperforming the S&P 500? And should I sell all my shares of this ETF and so much more? Now I hear ya, and I know your frustration is real, because a common mistake I see some SCHD investors make is only buying SCHD or having 100% of their ETF portfolio in this fund. This has caused some SCHD investors to not be happy when the market is going up and up and up and their capital appreciation is low, while other investors in growth, broad market, and slightly less value-oriented dividend ETFs are sitting really happy right now and cheering with the amount of money they've made in the stock market lately, because the stock market has been favoring growth stocks over the past few years and even over the past decade, while SCHD is a more value-oriented play and value stocks are out of favor in the market cycle. And a second common mistake I see SCHD investors make is not really understanding SCHD's true fund objective. So in this video, I'm going to be going over a total of 3 different 2 ETF portfolios that destroy only buying SCHD. So you could increase the potential of having higher returns in the long run than only buying SCHD, all while still having those high juicy dividend payments in these new 2 ETF portfolios that I have built for you guys, so you can get the best of both worlds of capital appreciation and high dividends. So without further ado, let's get started. Let's take a quick step back and go on Schwab's website and see the true fund objective of SCHD. On their website, it says that SCHD is highlighted as a straightforward, low-cost fund. The fund can serve as part of the core or complement in a diversified portfolio. So the key words here are SCHD can be a complement to a diversified portfolio. Now, when I hear the word diversified, I automatically think of broad market ETFs, or even adding growth ETFs to complement SCHD, since SCHD is not a growth or capital appreciation oriented ETF. Since just because SCHD went up for a long time and even outperformed the S&P 500 in a couple of those years, does not mean the objective of SCHD was to be more of a capital appreciation ETF to even beat the market. SCHD tracks an index focused on the quality and sustainability of dividends. And with this in mind, SCHD's goal is not to invest in growth stocks that happen to pay a dividend or even lower yielding growth stock plays, which is why SCHD's fund managers got rid of Broadcom in their most recent reconstitution, despite Broadcom being a great stock that has had high potential to outperform the market and has done so historically, which is why after the reconstitution, SCHD is now less tech focused and more of a defensive play because they got rid of most of the allocation from technology and it decreased that holding. SCHD is meant for investors to invest in this fund not for 1 year, not for 2 years, and not even 5 years. It's meant for investors to invest in this fund for decades upon decades upon decades. So hopefully you'll have a large enough nest egg of an investor's net worth, so you will receive these high juicy dividend payments, and these dividends will be increasing every single year because of the high quality stocks inside of this fund, and these dividends are going to be increasing and not going to be stable or volatile like a covered call ETF might be. And as a bonus, SCHD is meant to invest in value-oriented companies. So when value stocks are back in favor in the stock market cycle, you should see SCHD rise in value more than usual. And the Magnificent 7 tech stocks have been providing most of the stock market's returns lately. And SCHD does not even own a single Magnificent 7 tech stock and has been trailing most other ETFs. So with all that in mind, let's go over 3 of the different 2 ETF portfolios that I have built for you guys. Kicking us off is our first 2 ETF portfolio of a broad market ETF plus SCHD. Since SCHD could serve as a complement to a diversified portfolio, broad market ETFs are as diversified as they come. Because typically broad market ETFs have hundreds if not thousands of many different stocks from many different sectors, so you are going to have large cap, mid cap, and even small cap stocks inside of these funds, and some of these broad market ETFs even have international stocks, which are going to be stocks invested in other different countries, so you are not going to miss out on any type of fun if you have a broad market ETF. Some broad market ETFs I like are the Vanguard trio of either VOO, VT, and VTI, as well as SPLG and IVUV for non-Vanguard ETFs, plus some special mentions on your screen. Any of these ETFs are going to be great to complement to SCHD because you also have the Magnificent 7 tech stocks as some of the top holdings inside of these funds, which have been carrying the stock market's performance of returns and can increase the potential for you to have more money in the long run than not investing in any of these Magnificent 7 tech plays if you went all in on only SCHD. And another great thing about broad market ETFs is that they have really solid dividend payments and or solid dividend yields, ranging anywhere from 1.3% all the way up to 2% depending on the ETF that you choose. So it's a great option to grow your wealth through dividend payments and reinvesting and compounding those dividends because they have dividend growth-like characteristics, and sometimes year over year they will see a dividend payment that is higher than the previous one, so it might be a sleeper dividend grower. Taking a look at Portfolio Visualizer, if we combine 50% to SCHD and the other 50% of our portfolio to VOO, for example, the historical returns over all time frames has outperformed only buying SCHD from the other portfolio that we have made in this visualizer, and this will lead to you having more money in the long run and more gains in your pocket because of these broad market ETFs in your complement SCHD portfolio. The second 2 ETF portfolio is a dividend growth ETF that is tech focused plus SCHD. A couple of dividend growth ETFs I like to complement SCHD are VIG by Vanguard or VIG and DGRO by iShares, including some honorable mentions. Dividend growth ETFs that are more tech focused in their stock holdings tend to be less value oriented because SCHD is strictly a large cap value ETF. So in this case, dividend growth ETFs are usually categorized as blend. Now blend means a blend of both value and growth stocks. Like with VIG, which is a large blend ETF, which it says on Vanguard's website, and even DGRO, since it holds mostly technology stocks in its sector allocation, thus making it a large blend. So these 2 ETFs are going to be a touch more growth focused than SCHD, which is more of a value defensive oriented ETF. And these ETFs, even on their website, say that they are dividend growth focused, since these 2 funds invest in companies that are consistently growing their dividends every single year in these broad baskets of many different stocks. And of course, since these are going to be dividend focused ETFs, they are going to have a yield higher than your typical normal ETF, which is going to be amazing if you want that passive income in retirement or even in the near term, because they're going to have those high juicy dividend payments that are going to grow their dividends year over year if they are high quality ETFs, which is great for a dividend ETF focused 2 ETF portfolio. Taking a look at Portfolio Visualizer, if we combine half of our portfolio to SCHD and the other 50% to DGRO, the historical returns over all time frames except the 5-year of this 2 ETF portfolio have outperformed only buying SCHD. Which is why I truly believe you should actually have another dividend ETF if dividends are your jam, so you have a good chance of having higher capital appreciation and of course those high juicy dividend payments that dividend ETFs and SCHD can provide. So for example, let's just say we have SCHD and VIG. Let's say that SCHD underperforms the market that year and VIG actually keeps up with the market and outperforms SCHD. Our portfolio is going to be way higher in the green than having only SCHD because growth will be in the favor of value. And let's just say vice versa happens. Let's just say that value goes up and growth goes down. We're going to have SCHD outperform VIG or at least keep up with it. So we are going to be making money both ways than only betting on SCHD to get our portfolio into the green with a 2 ETF dividend portfolio. The third 2 ETF portfolio is a growth ETF plus SCHD. This portfolio is great for those seeking high capital appreciation, but also want to have some skin in the game for some really good dividend payments, which is why I included SCHD in this 2 ETF portfolio. A growth ETF is a smart play to complement SCHD in a portfolio because SCHD is not a growth ETF by any means. It's not meant to provide high capital appreciation, where a traditional pure growth ETF, that is its main objective, to provide high capital appreciation and high growth to your portfolio. Some great growth ETFs I like are SCHG, VOO VTI SPLG QQQM, VOO MGK, FTech, and even those honorable mentions. In my opinion, growth ETFs complemented with SCHD actually make you a touch more diversified because you now have large cap growth stocks with growth ETFs plus large cap value focused plays inside of SCHD. With growth ETFs, you also don't miss out on the opportunity of having significantly higher returns than the market because you do have tech stocks that are going to be at a higher weighting than usual than a traditional broad market ETF, and growth ETFs even include the Magnificent 7 tech stocks, which are not included inside of SCHD. Now, with all this tech does come the risk of heightened volatility. However, SCHD is great because it provides investors and their ETF portfolio with lower volatility. And the plus of SCHD with growth ETFs is that growth ETFs typically have a lower than usual dividend yield and lower dividend payments. Now, SCHD pairs great with this because it has high dividend yield and a high dividend payment. So you will have those high dividends in the long run than if you only bought growth ETFs. On a side note, you can have small cap ETFs and even small cap growth ETFs paired with SCHD because SCHD is a large cap value oriented ETF which does not include small cap stocks, and if you do have small cap or even small cap growth ETFs, you are going to be more diversified because you do have large cap and now small cap value stocks inside of the fund, or even small cap growth stocks. If we take a look at Portfolio Visualizer and combine 50% of our portfolio to SCHD and 50% to VGT, for example, the historical returns over all time frames of this 2 ETF portfolio have absolutely destroyed and outperformed only buying SCHD because you do have these growth stocks to absolutely rock your portfolio to the green and have massive potential returns in the long run. Now, past performance is never an indication of future returns, which is why in 2021, when people saw the past results of SCHD, they just piled all their money inside of this fund. Now, I know I've been using the historical returns of these ETFs, but in my opinion, I think that they're going to be pairing great with SCHD to diversify your money, diversify your risk, and hopefully increase your chances of making more money in the long run with capital appreciation and high dividends of SCHD. If you guys like this video, please give it a like because this Q puppy did, and right here is going to be another video I made of how much SCHD you should have in your portfolio by age for higher returns in the long run. And right here is going to be another 2 ETF portfolio, so you guys could go ahead and check that out. Now, hopefully you guys have a great rest of your day, continue to crush in the stock market, and take it easy. Peace.